Into the Gnar, where the cutting edge of software gets built. We're going to talk about real builds, real decisions, real consequences, the moments where things went sideways and how they got back on track. You don't have to cut corners to move fast. You need great people, you need great process, and that's what creates speed in the end.
One bad line of context is probably 100 lines of bad code.
We spent the last 10 plus years building software for companies of all sizes, from scrappy startups to $100 million operators and beyond. The gap between how software gets talked about and how it actually gets built is where most of the damage happens. This is Into the Gnar. Welcome back to Into the Gnar, where the cutting edge of software gets built. I'm Mike Stone here with my co-host, Nick Maloney, and I am super excited about our guest today. We've spoken with company executives in the past. Today, we get to speak with Cam Salem. He's the founder of Headlight Partners, a growth equity firm that partners with B2B software entrepreneurs. Cam is also a great friend. He is as funny as he is smart. Cam, welcome to Into the Gnar.
Great. Well, thank you both for having me. I'm really excited and ready to jump into the conversation.
Beautiful. To get us started here, just to set the stage, maybe you could give us a little bit of like how you ended up on the investing side of software.
Sure. So I have spent my career in technology growth equity. Like most people, I started on the investment banking side of the business at a small firm in Boston called AGC Partners, and then very quickly migrated to the buy side of that business, working for General Catalyst Partners in Harvard Square. Most well known for their traditional venture capital strategy, but I was on the growth equity team under Brian Shortsleeve and David Fialco. And what I learned to love about growth equity is how closely we were working with founders and operators of these businesses. By definition, growth equity has a much more concentrated portfolio than venture capital, but we're not using leverage and financial engineering to drive our return like traditional private equity. It's really about rolling up our sleeves and helping these businesses go from $5 or $10 million of revenue and one successful channel of customer acquisition to $25 or $40 million of revenue and a very diverse revenue base. And so it requires that we partner with founder-owned companies very intimately and deploy all of our resources and abilities to help them reach that next phase of growth.
So you worked with some pretty reputable companies in the past. What made you want to split off and start your own thing with Headlight?
I think it was really the natural evolution of the growth equity asset class. I would say after COVID in 2020 and 2021, the asset class went through what I would consider a super cycle. As we all know, interest rates were near zero at that point. And so lots of investors were risk on looking for equity positions in growth stage companies. And so ultimately that led to a very well-known investment firm, Tiger Global, entering the asset class. And they started to throw their weight around very quickly, paying 2x or 3x higher prices than anyone else was willing to for premium assets. And so all of a sudden we had to react to that. And we started to pay higher multiples at Updata Partners than we had typically done before. And the size of our portfolio grew exponentially as well. When I joined that firm, they had 8 active portfolio companies, and now they're closer to 40. And so just started to see a lot of change in our business and how we were able to interact with these businesses. And because we had taken positions at high valuations, the work was getting more difficult and there was less visibility into liquidity. And so as someone who was a junior member of that team, it started to feel like there was a interesting opportunity to hang my own shingle because all the other contemporaries and growth equity firms were experiencing that same challenge because of how aggressive they had been in 20 and 21.
Was it hard to get started with your own firm having to compete with a big player that was paying such high multiples?
There are certainly challenges to it, and it's hard for us to provide the same certainty and speed to close as some of these larger funds and more well-known names. But what was most interesting to us is we actually felt like our pitch was more different than it had been at Updata, because we were selling ourselves in a very concentrated approach to growth equity. And so the idea that my partner Jack and I would only be working with one, at maximum 2 or 3 companies at a time, meant that we could really position ourselves as a value add board member and somebody who was going to roll up their sleeves and actually help them tackle real problems versus just show up at the board meeting and hear how they were performing.
Very cool. Well, we're going to dive into that in some more detail shortly. Before we get into that, I want to run through a couple news stories from the past week that are right in your world and get your take on it. First one here is around what's been going on with IBM recently. IBM released their Q2 numbers that fell short of expectations. Their revenue was up about 1%. As a result, their shares have fallen pretty steeply. They're down about 20% in the last month. And sector-wide, you look at companies like Microsoft, ServiceNow, Salesforce, they're down about 5 or 10% in the last week. The CEO of IBM is saying that, or explaining this as, these large enterprise organizations are redirecting budget to AI infrastructure versus software and consulting. And the market seems to be taking this as a sector-wide hint. And so I'm curious, from your perspective, IBM is a legacy giant here. They've got kind of different budget conversations than the companies that you likely back. But how does a story like this trickle down to the lower middle market B2B software world?
Yeah, it's a great question, and one we're spending a lot of time with our LPs answering since the term SaaSpocalypse was coined, I think, in February. From our perspective, software remains a great place to be investing and focused, but it has certainly changed the calculus and the evaluation of business model strength. And so I think it's fair to say that gone are the days where feature and functionality are the only moat you need to be successful in software. And it now requires that you more closely understand things like network effects or other things that could increase the cost of switching should a viable alternative and a new software competitor that has feature and functionality at parity come to market. I don't think all software companies are created equal from that perspective, and the public markets have been particularly emotional, which they tend to be in terms of how it has impacted valuations over the last 3 or 4 months. But when you look at the fundamentals of these software companies, they're certainly a superior business model than traditional services or even tech-enabled companies. When you look at gross margins, profitability, and growth rate, they still outperform their peers. But this is really the first time in my investment career where these companies are now trading at discount multiples compared to the S&P 500. And so, to steal a quote from Warren Buffett, be greedy when others are fearful. And we're certainly trying to apply that to our own business, but spending more time pressure testing and understanding the real business model moat behind some of these companies, because ones and zeros are no longer sufficient to say we have a really durable business model, and the growth and path to revenue and profitability is clear.
Yeah, are you evaluating businesses any differently regarding a lot of people are foreseeing a big hike in AI spend across the board. And in this case, there's supply constrained hardware that these large enterprises are trying to grab. But as it filters down to us, and I'm curious where it lands with the companies you're working with, there are a lot of subscription based, like Claude subscriptions, for example, where they're taking a big hit and they're taking huge losses to provide this service. And there's a lot of anticipation around upcoming price hikes and what that's going to mean for P&Ls and company profitability. Do you foresee this rising cost in AI spend? And like, how are you reconciling AI cost and people cost? Hey, it's Mike. Before we continue, thank you for being here. Into the Gnar exists for one reason: to cut through the noise around custom software development and give you something actually useful. We want to build a community around that. So if something in this episode hit, or if there's a topic you want us to go deeper on, leave a comment. It genuinely shapes what we'll make next. Also, if AI is on your roadmap and you're not sure your team's set up for it, we made something for you. It's a free 2-minute assessment over at thegnar.com that tells you exactly where you stand. Link is in the show notes. All right, back to the conversation.
I think at the moment it's still a little bit of a black box. The AI market is so dynamic that it's really difficult to understand how pricing will trend in the longer term. The hyperscalers, or king of the mountains, OpenAI and Anthropic, are certainly discounting the price for the sake of customer acquisition, and how long that continue, I'm not certain. But there's also this threat of open source that I think is going to impact a lot of their decision making and how they think through the game of 3D chess. It seems to me that they all are very focused on reg capture because of this, and they see that as their biggest moat to defending their position in the longer term. And so how it's impacting the pricing and the consumption of all of this in the longer term is really difficult for us to wrap our arms around. But we are assuming that at some point there will be downward pricing pressure, even if they discontinue the discounting that they've been going to market with so far.
That's something that we've been, I wouldn't say struggling with, but just keeping in the back of our minds, where right now it's not a loss leader, but they're offering discounted prices, but we're capturing what it could be 6 or 12 months from now because they surface that information. Just so if it does shift into a more consumption-based pricing model, we'll be able to look at historicals and kind of compute what that build-out cost would have been. And I'm curious if other companies are taking that approach, or if it's so unknown, is it just let's wait and see how it shakes out from the pricing perspective?
Yeah, it's really interesting because in some regards, we have a front row seat to all of this through our investment in FinOps, which is a cloud cost management solution originally built for AWS and now has extended to Google Cloud and Microsoft Azure. But because we help customers reduce their cloud spend and manage those instances, they're all coming to us and asking for help with AI. The challenge that we have is it is such a dynamic market that right now, the best we can do for them is provide visibility. Remediation in that second and third step, it just doesn't exist based on the maturation of the market today. And so we're doing some of that piloting with existing customers, and it's certainly an exciting growth opportunity for us because it's dominating LinkedIn feeds, and you're hearing about how Uber blew through their budget in 3 months. And so the problem is real, making sure that we have the right to win there. And I think it will be very competitive, but also timing the market is part of the challenge for FinOps today.
And I can see that being a whole industry about cost savings for LLMs. Like there will be consulting firms that are token optimization once it hits that cost threshold.
Yeah, I mean, it's really interesting. We're seeing the FinOps players try and tackle this. Cloud Zero really just completely rebranded, and in their whole mission statement is around managing AI spend. We're seeing data observability businesses say, hey, we have the right to win this. This is really an observability issue. And then I was listening to the All In podcast, and they talked about how Ramp, the fintech platform, was creating a solution based on credit card limiting for AI usage. And so that was something that I was really interested to hear. I would have never guessed that a fintech platform felt like they had the right to win, and I'm not sure that they do, but they've identified it as such a large issue that they can't ignore it because their customer base is mostly software and technology businesses.
Yeah, that's super interesting. I think that kind of leads into a next story, which is a kind of pricing shift within these AI-focused software platforms. This week, Sierra, which is AI for customer service, broke some news that they are now billing based on tasks completed and less around these seats or licenses. A lot of vendors are joining them in paying per outcome or per task completed. Sierra was co-founded by Brett Taylor, who's a really well-respected executive and OpenAI's chairman. They've raised almost $1 billion, and this is becoming a trend, this outcome-based pricing. And I'm curious, from your perspective, does outcome-based pricing, one, I guess, are you seeing this in businesses that you're looking at? And does this make a B2B software company more or less attractive to you?
Yeah, it's a great question. I mean, I think fundamentally it's a shift that I think will have to occur at its simplest form. A software company is either helping you as a customer generate revenue or increase profit margins. And so outcome-based pricing certainly aligns with that and allows you to convey ROI in a much more succinct manner. But we haven't seen it play out at the portfolio company level quite yet. Everybody has been talking about downward pricing pressure on seat-based license. And I think if you're a venture capitalist and you're thinking in the duration of 10 to 15 years, that's certainly a threat that you need to consider for investments you're making today. For a growth equity investment firm, we think of our time horizon as anywhere from 3 to 7 years. And so it's a little less top of mind for us, but it's something we're giving consideration to. And one of the things we really love about NOps is they are outcome-based pricing. And so you pay them a percentage of the money they're able to save you on your cloud infrastructure. And that really lands well with customers and makes the whole sales cycle a lot easier to predict and manage. Now, the downside of that is future financial performance in periods are more difficult to forecast because we have usage-based pricing. And so one of the main advantages from seat-based pricing as an operator is you have great visibility into your future cash flows. And so you can make investment decisions based off of where you predict your annuity base will be in 2 or 3 quarters. And it's very unlikely that you're going to be really far off with that prediction. That whole paradigm changes because of usage-based pricing. And so it makes it a little bit harder to invest and be risk on with these businesses.
Do you think, if you were to bring out your crystal ball, do you think this is where B2B pricing ultimately lands? Or do you think seat pricing or some other pricing mechanism will end up winning out?
I think it's very industry specific. I think one of the areas we focus on is IT infrastructure. That will certainly become more outcome-based from a pricing perspective. But then the other area where we spend a lot of time is vertical market software. So looking for category kings of niche end markets. I think that will be a lot slower to mature and develop, and the seat-based pricing has more durability in that type of market.
Yeah, I'd imagine it's a lot easier to start a company with outcome-based pricing than to take an incumbent and migrate from seat-based to outcome-based pricing. I mean, have you entertained any conversations with any portfolio companies or companies you're looking at who are considering that move and how they might execute it?
We're talking about it at our second investment, a business called RepSpark, which is a B2B commerce platform for golf retail and decorated apparel. Today, we get paid an annual subscription fee by the brand, but what we're really doing is powering a transaction between brand and wholesale partner, which in this case is the pro shop. And so we do think there's a future where we're more taking a percentage of the transaction volume. But one thing we're struggling with is how do we transition towards that, right? What is the crawl, walk, run maturation towards usage-based pricing? But philosophically, I feel very strongly that it's the right decision because ultimately it aligns us better with the customer and the outcome that they're wanting. And then because I think of this business as a software-enabled marketplace, meaning we're serving constituents on both sides of the transaction, it enables us to create a win-win where if we make the pro shop happy and then we make the brand happy, we'll start to make more money altogether as a team.
Yeah, that makes sense. When there's an obvious outcome and that outcome can be measured as good or bad, I think that is a good case for the outcome-based pricing. When I think about the outcome-based pricing, I think a challenge that some of these companies are going to have is that task doesn't always mean that the task was done well, right?
Right.
And
It's not.
People are going to be frustrated if they're paying for task completions and the task wasn't completed well.
Right. So then I think the question is how closely is that task
Like you close a Zen
aligned to an outcome, which is really
for
revenue or
customer
profit,
service,
right? At
but
the end of the day, that's what a business
told
does.
them
They're
to
either
F
trying
off
to,
in the
they're in
process
growth
like
mode and
that.
trying to create
You wanna be
revenue, or
happy
they
about
want to
that,
improve
even
their
though you
margins.
close the ticket.
Did I lose you all?
Oh yeah, we lost you for a second there. I think you're back, but we missed your last point.
Sorry, I'm Weston. Got boonies. The internet out here is not as strong. What was I saying last time? Just remind me what we were talking about.
Just on the like good outcome versus bad outcome, like your outcome with what you're doing with RepSpark.
Yeah, exactly. So to your point, if the task is obfuscated from the outcome, then it's not going to work as a pricing model. I think you need to be able to correlate the task or the pricing unit to revenue or to profit margin. And that's the most simple way to think of these businesses in the long run, right? All of your customers, regardless of industry that they're in, are trying to achieve those two objectives. Some focus on revenue more and some focus on profit margin more.
Yeah. Awesome. Well, let's get into the real stuff here. I want to dig a little deeper in how you think about business, Cam. You brought this up a little bit, the definition of growth equity earlier. You kind of sit a little bit later than VC, but you're earlier than buyout. What makes this the right stage for you? And can you market Headlight as personalized growth equity? Can you maybe go into a little bit about what that means day to day for a founder?
Sure. So starting with your first question, I really fell in love with growth equity after I got exposure to both venture capital and growth equity at General Catalyst Partners. I always had trouble wrapping my mind around how to be a successful venture investor because it's a very high level sport that you're playing, and it's really difficult to know how successful or unsuccessful you are before these companies mature. And sometimes that can take 7 to 10 years. The other piece that was difficult for me with the VC model is it's really about making a large number of bets. And so the intimacy and the level of support that you're providing these portfolio companies by definition is limited. You'll be as helpful as you can. A lot of it is introducing your founders to the people in your network, but besides showing up at that board meeting and doing your best to prepare for an hour or two beforehand, you just don't have the bandwidth to help these companies in the way that you do with the growth equity strategy. And so what I really loved about UpData was it's a firm that was started and founded by former software operators versus career investors. And so we really did take that mentality across the boardroom into the playing field and helping these businesses with customer success or product management or thinking through their channel sales strategy, all of the things that are required to go from 15 or 20 employees to 150 and break fewer things along the way. And so developing that skill set and muscle at UpData really helped me fall in love with this stage. And it's really fun to partner with these founder-owned businesses and roll up your sleeves and do everything from helping them with instrumenting their business around the unit economics to building sales decks to tackle a new channel or opportunity. And it's that level of focus and that concentrated portfolio that we want to deliver at Headlight Partners to our portfolio companies. And so we're very purposefully only making 1 or 2 investments in a given year so that we can deliver on that promise.
I guess, what's the best way to frame this? So is the value add that you're giving to these investments based on a network of experts and centers of excellency that you have either in-house or through partnership? Or is it based off of your personal experience and helping them on the finance side or wherever your kind of skills align?
Yeah, it's a little bit of both. And then the last pillar, the last leg to the stool that I would add is we're partnering with bootstrap founder-owned businesses. And so a lot of times it's just that close personal relationship where the founder has never had somebody to run difficult decisions by or to have a strategic partner who's rowing the boat in the same direction as them. And so a lot of it is just being in the foxhole and being a good teammate for our founders, which also requires that we have a concentrated portfolio so that if they call us on 6 o'clock on a Friday night, that we're willing to answer and help them through whatever issue has come up in their business. And I'm sorry, what was the other part of that question?
I forget. No, just around, are you leveraging your experience?
Oh, yes.
Yeah.
And so part of it, then the other leg of the stool is we know what great looks like. We've spent the last 15 years of our career working alongside the best software businesses in the world. And so seeing how they run reporting and how they communicate with the board and how they think about new feature development is all things that we've learned through osmosis and being around these businesses. And most importantly is we bring the strength of our operating advisor network. And so we've spent a lot of time developing and building a bench of great operators that aren't typically CEOs of larger software companies, but they're that next layer down. And so the SVP of sales or customer success or the director of product management, we're looking for people that have a specific skill set where when we identify an issue or challenge in front of a prospective portfolio or existing portfolio company, we can deploy them into that and they can say, hey, I've seen this movie before. Here's what we need to do. And it comes with a lot more credibility than me and my partner Jack delivering that same message because we've never sat in that CEO chair. And so we have good pattern recognition, but we also know what we don't know, which is that you need somebody with that operating experience to drive a lot of these decisions and processes forward. And so we'll go into an investment with 1 and sometimes 3 operating advisors sitting at the board level or in an advisory capacity where they're meeting with department leaders on a weekly basis to drive change, and we're all working through the same set of goals, whether it's the company mission or the annual goals that everything rolls into.
Kim, one of the reasons we were excited to chat with you today was we operate heavily in the B2B space from a much different lens, but your perspective is, I think, really, for me, very interesting. And you see a lot of pitches. And what would you say separates B2B software companies that are growing right now versus the ones that are stuck?
Yeah, I mean, it's a great question, Nick. I think growth is a mentality. And so you need to have that mentality starting with the CEO all the way down to the individual contributor at these companies. And so a lot of these companies, it's either a cultural issue or they're just not thinking through the chess pieces in the right manner, and they're too focused on the here and now versus how do I get to where I want to go in 18 months. More specific to today, we are seeing a bifurcation between the companies that are AI enabled and those that are struggling to figure out their strategy. And so we do see more growth persistence in these companies that have been focused on how do I deploy AI for our business and how do I make our customers more successful with AI?
Growth is a mentality. Put it on a billboard. I love that.
That's right.
Riffing on that a little bit, because you also have the VC background, and know, at least from chatting with other folks there, the personality and just the background of the founder is so important, because these startups, they don't have a rich business history, where in your space you have some more data points in theory, where I'm sure you have sort of a ideal profile on the founder, but then you have more mature financials. But is there anything that, and it could be totally random, but anything common pattern that you've seen with founders that it might not answer or check off all of the marks, but you find is a welcoming pattern as you're looking at new companies?
Yeah, I would say the defining characteristic that I've been able to identify is deep domain expertise. And so particularly as we think about vertical market software, we want to identify founders that have lived the pain of the customer. And so they intimately understand the problems that they're trying to solve and the workflows that are required to be successful in that position. And if we can find the person that has that really difficult to replicate domain expertise, we feel like we're the perfect complement to them, which is we know what a great growth stage software looks like and behaves like and invests like. You know how the customer feels pain. Let's marry those two things together, and that should take us to the next level.
You know, we've seen similar patterns when we partner with firms, and the founder is, well, not only has deep domain knowledge, but oftentimes like they're truly like passionate or enthusiastic about whatever industry they're in. Like that guy knows his stuff. And I like learning about the businesses too, because you learn the machinations of what a specific industry, what drives them. And it might be something I knew absolutely nothing about, but it's going to be cool to go into something and just learn specifics about that industry.
Yeah, exactly. And I love talking to people like that because I learn something so quickly and then I can complement it with my expertise in growth stage software. And I think back to that point of growth mentality, it's really important that these founders have an insatiable need to learn. And it's something that they like to challenge themselves on because there's always new problems that face an emerging business. And our expectation is not that the founders are experts in all of these at once, but it's that they're willing to learn quickly and move quickly to figure out how to move beyond that.
Yeah. When I touched upon what are things that are, we'll say, green flag or what you look for, are there any patterns you see that signal you might want to pass on, or red flags, whether it's person, industry, or something when you open up the books that's a signal that you might not want to pursue?
Part of the Stone family, the red flags.
Yeah, I've had a few introductions to ancillary members of the Stone family, and so I'll no longer be fielding those calls for investment. No, I kid, but I think the one thing that I have struggled with is when the founders are not commercial enough, and so they're too product oriented, and they're not getting in the weeds on the sales process, and because of that, they don't have good telemetry on the voice of the customer. And so I think having commercial capabilities is a requirement to be a successful CEO. And now maybe it's just based on sort of the asset class and the type of businesses that we're looking to back. But for companies that have CEOs that are totally focused on product, I think they often miss the tree line for the forest. Is that the same? Tree line forest?
Miss the forest for the trees, or I don't know. We get it. We got you.
Yeah.
I'm kind of curious too, like when you think about a founder or a business, how important is it that they stay like steadfast in their direction versus remain open to change? Because I think when I think about an early stage company, they have to be very open to change. And that's why the VCs are really betting on the founding team, is that, hey, it might not be this idea, but this team will figure it out. You're a little later stage where they found some form of product market fit. We now have this environment with this AI whipsaw that's AI's released. Oh, everybody's AI implementations aren't actually moving the needle. Then we go full SaaSpocalypse, where if you're not using AI, you're dead. And if you are, you're probably dead anyway. Only Anthropic and OpenAI will survive. To, oh, actually, companies aren't really getting the value out of these that they're really paying for. Maybe this is two-part, but in the same vein. But when it comes to the company vision itself, and when it comes to adoption of tools, do you think there's value in staying like steadfast in direction? Or how much do you encourage these teams to really play with what's going on in the industry?
It's a great question, and I think one that's particularly relevant for us because of the stage of company that we're typically backing. And so I would agree with you at that startup phase when it's two guys or gals with an idea in a garage. The most important skill set is that you're willing to iterate and move quickly. Once you graduated past product market fit and are having commercial success, the role of the CEO really starts to transition, and you need to own the longer term goal for your business. And so this is an area that we almost 100% of the time have to do a lot of coaching with our CEOs on, because all they've known and why they've been able to successfully build that business from two guys or gals in a garage to $10 million of revenue is because they have that relentless hustle gene. Now, once you start to get to 30 employees and put more processes in place, I actually think that can be an enormous drag on the performance of the business. And your employees will start to experience the whiplash, which I'm sure we've all experienced at one company or another, where it just feels like you don't have direction, and then there's a little bit of a dissonance between what your responsibilities are and the direction you're getting from your founder. And so it's an area where we try and coach our CEOs pretty often, which is, okay, you've done a great job getting it to this point, but now we need to think about 1 and 3 and 5 year goals and start to make some bets on those. And of course, we'll preserve the option to course correct, but there needs to be a longer term vision in place so that we can think about what this sales team looks like in 6 months, in 12 months, or think about how our customer success strategy is going to evolve. And we're going to build specialization into account management and customer support and everything that constitutes what is typically firefighting at the early stage when you only have 10 or 15 employees.
Kind of sort of few quick hit questions that we partially covered, but not completely. For a CEO in some of these mid-market B2B companies, are there any or is there any one element of AI strategy that they may not be doing that you've seen and would recommend?
It's a good question. I think the most successful businesses are figuring out how AI can impact their operating costs versus being totally focused on the customer value at the moment. I think the lowest hanging fruit is how do you enable marketing or sales or engineering with the tooling so that they can do their job better and with fewer people today. And that, I think, is where the real obvious impact is for all of these businesses versus the customer facing AI tooling or whatever it means for your particular business model is still a little bit squishy. And I haven't seen too many companies in the growth equity landscape figure out.
Got it. And it's pragmatic. It's not necessarily an AI problem. It's solving for efficiency, but AI is the means in which they do it.
That's right. There's always different flavors of it, but I think at this stage of AI, you need to encourage your employees to take risks because nobody has the answer. And what you're really trying to do is just get as many shots on goal as you can and figure out what are the right ones to start taking.
Yeah, what sticks. Completely separate from that, are there any growth equity myths that you're aware of that you'd like to dispel?
Growth equity myths. I would say that we aren't private equity, that when we get into these businesses, we are certainly conscious of spend and want to do everything as efficiently as possible. But the North Star for us in these businesses remains revenue growth. And so while fundamentally I do feel that all businesses should be valued on their ability to create future cash flows, we take the lens of let's invest in fundamentally strong businesses that have durable business models and good gross margins and go risk on a couple areas where we see growth potential. And we're not sacrificing our ability to create cash flow in these assets if growth doesn't manifest the way that we think it could, but the clearest way for us to return capital and to do so at good return rates for our LPs is to drive revenue growth.
I love that. That's great. I like the answer around like risk with embracing that. It's like you're back in the trenches on Saturday mornings with the Milton Academy Mustangs if you're going to fail at full speed.
That's right.
All right. Well, we're just wrapping up here. And before we let you go, we've got a rapid fire section. So these will be some quick hit questions. You'll just go first thing that comes to mind. And Nick, maybe we can alternate here, but I'll start us off. If you could build any piece of software in the world, unlimited budget, what would you build and why?
Wow. If I could build any piece of software, I think I would build something around collectibles. I've been spending a lot of time with my oldest son collecting basketball cards, and I think there's still a lot to be desired in terms of how that becomes a more digital experience. I remember growing up and rushing home to take the Beckett magazine out of the mailbox, which would tell you the prices of all the cards that you had in your collection. And I haven't been able to find a replicable experience to that online. I know there are a few sites that say if you take a picture of the card, we can tell you what it's worth, but I think bringing that and making it both an analog but digital experience and adding a social component to it has a lot of potential. And it's just something I'm really interested in as I start to collect basketball cards with my oldest son, Will.
I love that. I'm glad you're doing basketball cards versus my son's getting into Pokemon. So
Yeah, we had about
sports cards over Pokemon. But I've had a lot of conversations around this because also the mechanics of trading cards, especially kids trading cards online, is horrible and ripe for scammers. So you're definitely onto something here.
Yes, well, we've all been on the good and the bad side of a card trade when we were kids. I remember my neighbor tricked me into selling my Gary Payton or trading my Gary Payton autograph card for some crummy Charles Barkley card, and I've never seen my mother so upset as when she found that out. And then on the flip side, I made a trade for somebody's Roberto Alomar MLB Showdown card. That was a little bit of a ripoff, and my mother made me trade it back. But I love that aspect of it. I mean, seeing my two boys trade cards and then one of them will rip the other one off, it gets me really excited.
I'm still upset. I thought that because I got the Fleer Ultra Shaquille O'Neal rookie, I'd be able to retire early in 20 years.
Was that the one with him in the LSU jersey?
No, not that one. But I think that one's probably worth some bucks now. But yeah, we got these cards like back then the Mickey Mantle was worth 50 grand. And we're like, yes, Ken Griffey's going to be worth 50 grand one day. I still have in my basement and they're worth less, but I can't get rid of them. So maybe someday.
That's right. I was a kid. I had a Sean Kemp autograph that at some point Beckett told me was worth $600. And then he went on to play for the Cavaliers and put on 100 pounds and became a raging alcoholic. And so that was not quite as valuable anymore.
No, not in the retirement portfolio.
But Stone, you'll laugh. My son was very into the Pokemon cards. And then one day I took him to a Celtics game. And then I would say a week later, his cousin gave him some basketball cards. And he just was like, I'm done with Pokemon. I was like, great.
Yeah.
Noted. I got some games ahead of us in the Stone.
But I know more about Pokemon than I ever thought I would. So I know they're both fun.
More business related, but the ChatGPT, Gemini, or Claude, do you have a preferred tool there?
I have been loyal to ChatGPT until the last week, and some of that was based on the recommendation from Mike. And so I am now immersing myself in the world of Claude, but I would be curious to hear your perspective on that, Nick.
I think there's an industry-specific lens to it. In engineering, Claude Code is currently the best tool, but ChatGPT is a very close second, so I wouldn't discount that, but those are clearly the front runners. Gemini for a while was doing okay, and as of late, it's kind of B or C tier, so I don't think you can go wrong with either Chat or Claude, but you'll see more of it in the engineering space on the Claude side.
Now let me ask you all a question. Another belief I have is that there's diminishing marginal returns from intelligence. And so at some point, does it really matter how on the frontier each of these models are if we're all asking them the same questions? And does that mean that we'll do some tasks in less sophisticated models and some in others? And then how do you figure out how to segment that all from an operating standpoint?
Yeah, you nailed it. Like the task really drives what model is best suited for it. So for very complex thinking with a lot of inputs or complex software system designs, you're going to want a more complex model. Like Fable's now come up and it's expensive, but the results are really good. But using it for rote tasks, it tends to overanalyze and be too much horsepower, and you're fine using some of the more lighter weight models. So really just match the model for the complexity of the task and how big your inputs are. If you had to do analysis on a bunch of Excel docs and massive PDFs, you're going to want one with a larger context window. But for more conversational type responses, like Sonnet or Haiku are probably fine.
And so ultimately, how does that play out at the company level? Meaning, do you have some employees based on their title where you give them access to a certain model because most of their workflows fall under that? Or do you say, tell me what the task is, and then I'll point you to the right model?
It depends on the sophistication of the org. So for instance, our engineering team, we have tooling in place where you can essentially work with a model. It'll spin off sub-agents that make a determination on how complex the task is. So it might break it down into 5 pieces and say, this one is going to Opus, this one is going to Haiku. So there's intelligence behind it. And I think we're going to see a lot more of that in the industry. But if you know right off the get-go what you're trying to do, we just sort of educate folks on what's the nature of the task and provide guidelines and recommendations for what model. We're not prescriptive or we don't have any mandates. We just try to educate so that they're using the right tool for the job.
And a lot of times you'll break down what it means to produce a feature where you have, and this is how you would do it as a human. You plan the work, then you execute the work, then someone reviews the work. And so you might have a different model that does each bit of that. We used to say coding was 90% planning or thinking about what you were going to do. It's not actually hands on keyboard. So you might use a more powerful model like a Fable or Opus to do the planning, and a lighter weight model to do the execution, and another one to do the reviews. You just break it down by complexity of the task.
And do you all dabble in the open source models at all?
I would say dabble, but we don't use them day in, day out. And a big reason for that is just the overhead of the infrastructure to run them, whether it be we'd have to physically run hardware to run the models, and to run some of the more complex open source models. If you factor in just the compute costs and everything else, the labor involved to set those up is not, for what we do, there's not a strong ROI versus just using Claude. I think that's going to change. I mean, especially with how good some of the newer open source models coming out are. But I think there's still a gap in how accessible and easy they are to spin up, especially for smaller organizations that don't have the infrastructure or expertise to do so.
Super interesting.
A great question. Like, that's on the top of my mind for sure.
Yeah, and I know we're coming up on time here. I want to ask you one last question because I know you're a scrappy guy, and I just want to get your take on this. Would you rather fight 40 duck-sized horses or one horse-sized duck?
Oh, I mean, one horse-sized duck. The strength of the wolf is the pack, as they say, and so I'd much rather be focused on one opponent than have 40 things nipping at my ankles. And so that one's an easy one for me. But as I say to anyone who's ever been in a bar fight with me, you may win the fight, but I'll get my pound of flesh.
Amazing. Well, Cam, thank you so much for joining us. If you're in the middle of a software decision you're not sure about, or you need a team that ships without chaos, come find us at Gnar.com. Until next time, stay curious, stay sharp, would ya? And we'll see you in the Gnar.